All right, guys, welcome. Welcome to today's call. We're talking with a new friend, an individual who we met at the Noteworthy Convention in Las Vegas, which we were speaking at a couple months ago. We have Larry Tepper of Ridgegate Financial, LLC. He has been involved in the note appraisal business, in the note mortgage loan business for 35 years, and he primarily works with attorneys, CPAs, and certified financial planners providing valuation of real estate notes for the purposes of state and tax purposes. So with that being said, welcome, Larry.
Hi, how are you? Good to hear your voice again.
It's good to hear you again. Terry, you with us? Terry.
I'm here. Sorry about that. I didn't know I was supposed to respond. So,
All right.
Larry.
Hi, Terry.
Hi, Larry. I'm great. It's good to talk to you again. It was the paper source that we met at, and we started a very interesting conversation that we didn't get to finish. But I've been wanting to speak to you about this conversation we started up on notes, and then we brought in Dodd-Frank Act. So, to begin with, Larry, how did you get into the note appraisal business? What's your background?
Well, I've been a real estate broker, a managing real estate broker for more years than I really want to confess, but I'll say it's over 35 years. And in the early 1980s, the mortgage market pretty much dried up. The bank lending, the institutional lending market dried up, and prime interest rate was about 19%. And so most people buying and selling houses couldn't qualify for a 19% loan, and if they could qualify, they didn't want to. And so as a real estate broker, we had to figure out how to make a living in that environment. And what we realized is that we could help people sell their property and help people buy property without banks by using seller carry financing. So we started as real estate brokers putting deals together with no outside money, no bank money. And what we were really doing is creating promissory notes representing the equity value in the properties. And if a person wanted to sell their home, they would sell it and carry back a promissory note, a seller finance note, and then we as brokers would go find somebody who had a property that client could buy with a promissory note. So basically that's how the terminology paper came into being. We called ourselves paper dealers. They were promissory notes. And so that was my start in the promissory note business in the 80s, and I ended up becoming not only a real estate broker, but a promissory note owner and broker, because you have to remember, if there was no bank injecting cash into a deal, how was the real estate broker going to get paid? He'd get a commission, which was a promissory note. And you can't go to the grocery store with a promissory note and buy groceries. So we had to figure out how to convert those commission notes into money. So kind of in a nutshell, that's how I evolved into the note business. And after doing that for about 29 years or so, I decided I would kind of become an appraiser of notes rather than out buying and selling them myself. So for the last 6 years, I've been a professional note appraiser working for attorneys and CPAs and financial planners around the United States.
So, so you cut your teeth like I did in the 1980s on these items, these notes, and then basically it kind of went away because interest rates got lower and lower and lower, and loans became easy to get. So would you say we're in an environment today, although it's not a 19% environment, would you say that it's similar in the fact that it's hard to get a loan through an institution today, and we're maybe trending back to those days of the 1980s?
It looks to me like for the average working type family, let's call them the middle income family and down, it's very hard to get good bank financing. From what I read in the paper and what I see is the banks are being very selective, and they're making loans to gilt-edge people. They're making a lot of jumbo-type loans, but for the average borrower, it may be a struggle. So I would say we're kind of trending back toward where seller financing will be an excellent tool.
Okay, so I would say buying a home doesn't necessarily have to do with the interest rates, it looks like to me, although, you know, that was a play in the 1980s. More so, it's a matter of, is financing even available, which we're in historic low levels now, but since these new laws were created, and I guess we'll get into that question in a minute, it doesn't matter how low they get if you can't get a loan.
Correct. That's right. A low interest rate that you can't qualify for doesn't make the transaction happen.
Right. So Mark?
Yeah, so Larry, before we get into what gives a note its actual value in maximizing the value of a note, what can you say about Dodd-Frank Act and people that are ignoring it and creating real estate notes with the idea that they're gonna sell them and get maximum value down the road? And specifically in our space, you know, the fact that we are mortgage loan originators and we have a service that is provided for the sake of, you know, proving that it is compliant and putting that in the paperwork.
I would say that any time a person originates a promissory note and doesn't comply with any law, whether it's a usury law, a fraud law, a consumer protection law, any time a note is created that does not comply with the laws, it's going to be heavily discounted. So I would say the Dodd-Frank and the consumer protection laws have just added a very thick responsibility onto anybody that's going to have a promissory note and wants to sell it. And in fact, I would say even if a person originates a promissory note on a seller finance deal and doesn't intend to sell it, they could have the borrower come back against them if they're not in compliance with all the laws, including Dodd-Frank and the consumer protection laws.
So even creating it without the intention of selling it is, in your opinion, potentially a bad idea for the value of that note. Even like you say, you appraise estates and people that own notes inside their estates and they've never sold them. It could affect the value even later on down the line, which we agree with, by the way. The Dodd-Frank Act is just you know, a tremendously it's a law that just it creates all kinds of compliance that I don't think people out there in the world are understanding.
I agree with you. I think it's I would analogize it to a ticking time bomb. I think that it's going to explode on some people and they're going to be completely surprised by it because it's really not publicized to the general public. You know, the typical homeowner that's selling a home and carrying paper back has probably only sold 1 or 2 homes at the most in their lifetime. And they don't pay attention to those laws and rules like people do who are making their living in real estate. So I agree with you, and I would say it's a ticking time bomb.
So let's talk numbers. How much in terms of valuation does a non-compliant note, you know, and you make a great point, it's not just complying with the federal level in terms of the S.A.F.E Act and the Dodd-Frank Act, but as well the state level. So what can you say, obviously, you know, without going into, you know, a very specific scenario, but what can you say about the valuation? I mean, we know an individual who buys and targets non-compliant notes, and he buys them on, pennies on the dollar. What are your thoughts on that?
I would say that if you know somebody that buys them for pennies on the dollar, he's probably a very rare bird. Most investors, now I'm talking about investors, not speculators, most investors wouldn't touch one of those with a 10-foot pole, even for pennies on the dollar. The only people that will buy those non-compliant notes are speculators, and they basically have to have a tremendous discount to cover all the risks that are getting involved with.
Yeah. Terry, what does he pick those up for? He buys them at 1 or 2 cents on the dollar, something like that?
Well, just to keep it simple, almost nothing. But the problem even with that, which what Larry is touching on, is that if a non-compliant note is originated, and let's say 3 years down the road, it can be challenged either by an attorney or the CFPB. The penalty is rescission of the note and repayment of interest over that whole 3 years. And in some cases, even jail time if it's something that this person is doing that created this note or others, to fraudulently, take money away from consumers. So Larry's point is that most people wouldn't touch it is because it comes with, this rescission and this repayment of interest. Is that not where you're going with this, Larry?
It's exactly where I'm going, and that's why I used the term a ticking time bomb. Somebody could buy a note in good faith without guidance and end up getting called into court, lose all their principal, lose all their interest, and pay attorneys to keep them out of jail. And that, to me, is a ticking time bomb.
Okay. Mark?
Is that clear? Is that clear?
That's very, very clear, and that's why when we had this conversation back at the paper source, I found somebody that was not that was agreeing with me and what this all was about, and I'm hearing deaf ears in the marketplace, and it's hard to understand to know if you're in the right spot or not.
Well, people are coming around.
Let me tell you why I think you're hearing deaf ears, or why you're... Well, my point is they don't understand. And that's probably one of your tasks, and my task is to help people understand the risks of not understanding.
Yeah,
it sounds like we're creating a lot of... Go ahead, Mark.
Well, it's interesting because everyone in the business likes talking about due diligence, and you hear these guys, they like to throw around the lingo and jargon, and you hear guys saying they're due deal, and they'll analyze a deal to death, but they'll go forward with trying to get around federal law that has been made very clear, and we talk about this in our book. We actually quote the Dodd-Frank Act that any intention to go around or circumvent the act by definition and try to circumvent the act in its spirit is by definition a violation of the act in itself. So there's people out there telling people that they call something a forbearance so they don't have to comply with the Dodd-Frank Act, or put it in the transfer a property into a landholding title trust, or have a buyer buy a property and tell them to take title under a trust. And lease options are not, even though it has consideration, it's not a sale, so therefore it's not subject to the Dodd-Frank Act. And it's amazing to me that, that people in the industry, by and large, understand the value of due diligence, but they don't seem to take the due diligence in, they'll look at due diligence when buying a note, but in terms of note creation, they seem to bypass it, and not everyone, but there's a small minority group that are looking for ways to get around this federal law, and it's mind-boggling to us that it's still happening a year later.
Well, it doesn't surprise me because most of the people who buy notes are more sophisticated and understand due diligence, and that's contrasted to the people who are creating notes when they sell their home. Most people who create notes when they sell their home are unsophisticated in the real estate field, and they really don't know that they're dealing with a ticking time bomb. And if somebody tells them, let me show you a shortcut, you can ignore those laws, they're naive enough to believe them. So I think you got to remember that buyers of notes are much more, in my opinion, generally, much more sophisticated than the typical homeowner creating a note.
Yeah, I have to agree with that. So this first half of the interview here now, Larry, is enough to scare someone, and I've actually had people say, and even funds and investors say, I don't do anything that's consumer oriented. I'll just do investor loans, which are exempt from Dodd-Frank, but not the usury laws that you spoke about. And so moving forward and trying to take a positive light, how can this industry change and morph into something that an industry maybe like what we're trying to do here, and we are doing actually as seller finance consultants, in creating a compliant package, or because the law doesn't say how to create one, it just says that you have to have one. So what is, in your estimation, a compliant loan if you know?
Well, I think let me answer that from the standpoint of a promissory note appraiser, because that's really my expertise. When I'm called in by an attorney or an estate or a trust to value a promissory note, I value that promissory note based on the documents provided to me. I don't do due diligence for them. I don't challenge what they gave me. So if they give me a real estate appraisal on the collateral property, I don't verify that that real estate appraiser was licensed and that he was in good standing, etc. I just take it at face value and incorporate that in my appraisal. Well, the same thing would apply if somebody has a promissory note in an estate or a trust that I can see was probably a consumer finance type transaction, a homeowner selling their property. I say to them, was this done in compliance? And usually they say, what do you mean? They don't even know that there's a risk. And I say, well, this looks to me like a consumer loan, and there are laws that govern it, and if you haven't got any documentation to show me that you complied, I'm going to have to discount that note, because a willing buyer wouldn't buy that blindfolded. A willing buyer would do due diligence and find out there was no compliance or there was no documents. So I think the effort to comply with Dodd-Frank and being a consultant is similar to being an expert real estate appraiser, where people have to use you if they want to really get maximum value out of their note. And they also should use you just like they should use an expert real estate appraiser to structure the deal before they close it. Because let's say a person sells their home and their life savings are in that home, and they carry back a promissory note. Well, what they're doing, they're carrying a promissory note on their life savings. Shouldn't they have an expert guide them to do that? So I think what you're offering the public is really a necessary service. It's just the public doesn't know they need it.
Yeah, I have to agree with that, obviously. And then one other thing there are some exemptions carved out of the Dodd-Frank Act, and Mark and I have gone over them, all the time with attorneys and different people, and our conclusion of the carve-outs or the exemptions are that none of them are really exemptions because they have caveats that if they're missed or not done properly, like the note has to be fully amortizing if it's 2 or 3, then it puts you back where the exemption, it didn't even matter if it existed or not because it wasn't done properly. And the only one true carve-out is, like you said, your mom and pop or your homeowner that has their life savings in the equity, and they carry back the loan so that they can live off of the income the rest of their lives. That's the only true exemption. However, how do you, if they have to sell the note or borrow against it, how do you prove to an investor note buyer that that exemption existed for them, that it was that one note that they had that they could, where's the proof? And the law doesn't say you prove it this way or that way, and that's another issue that we've talked about.
Let me comment on that. I think what you and Mark and your organization is doing is a pioneering effort. You are the pioneers. And the reason you have to be a pioneer is there is not any case law on the interpretations of these exemptions and carve-outs. In other words, this whole regulatory process has been put in the hands of bureaucrats who are writing memorandums on what to do. But actually, no matter what they write in their memorandum, a citizen can go to an attorney and say, I've been screwed, sue these people. And then the case goes to court and it gets adjudicated, and then you have some case law where you pioneers can say, look, this circuit court just held this way, and we're telling you this carve-out isn't a carve-out based on the way the courts are interpreting it. But right now, you're just pioneering in the dark. It's just a tough way for you to go, but somebody has to do it.
Yeah. Mark?
Yeah, I think that's a relevant point. At the same point, people are coming around as more and more people are coming around and embracing the fact that this is federal law. We're starting to experience this epiphany where people are saying they don't they don't want to be going up against a Dodd-Frank, contingency fee, hungry contingency fee attorney who's going to be coming after them or get thrown into court, possibly by the CFPB who wants to make an example out of them. And if you're smart, that's the way you look at it. Yeah, there's people still looking to violate the law, and we can't figure out why, but by and large, people are waking up and realizing that this is real, and that the time has come to get your business and your investment in line. On another note,
You're breaking up, Mark.
Okay, I said on another note, if we're talking about a homeowner that all their eggs are in one basket and they're converting their equity into a note, why wouldn't you want it be done? Why wouldn't you want it to be done correctly? And why wouldn't you want all your collateral file and materials there? And so that kind of morphs into the next question. Where do you see people making mistakes, Larry? Where do people, what are the common mistakes, let's move beyond compliance, but in terms of creating an investment grade note, notwithstanding, federal and state laws, and every state, as you know, has their own specific laws. Interestingly enough, the state of Tennessee, it bypasses the Dodd-Frank Act altogether. But where do you see common mistakes?
Well, I basically, and I'm not going to go into this specifically,
Sure.
When I value anybody's promissory note to try to determine its fair market value, I cover 19 different points.
Okay.
And the average lawyer is not aware of these 19 points because I'll give you a summation here. A promissory note to have maximum value has to have 3 elements, only 3 elements. One element is it has to be enforceable in a court of law. And most attorneys know how to make a note enforceable in a court of law. The next thing they have to know, whoever's originating the note, it has to be collectible from the borrower. In other words, if you go to court and get a judgment and you can't collect any money, the note's not going to have any value, or a smart buyer is not going to buy it. And the third element is the note has to be a marketable or saleable instrument. And many attorneys and many homeowners have no idea when they originate the note that at some date they're going to have to sell all or part of that note. They may need money for their grandchild's college education and so forth. So basically the mistakes that are made fall under these 3 different categories. Sometimes the note's not going to be enforceable in a court of law because it's violated some laws. Sometimes it's not going to be collectible because the borrower is broke and has no assets and can't pay. And sometimes the note's not going to be marketable because it's got some flaws or restrictions. So that's kind of an umbrella, Mark, and if you wanted some examples, some specifics, I could try to do it.
No, that's great. We're definitely looking for an umbrella when you go about the valuation process.
Let me add one thing, Larry. We have we put this on YouTube, so we can market it to our people that follow us. Could we potentially have you send us those 19 items that you look at, or is that something that's proprietary for you?
No, I can send you what the items are. What the proprietary part is, knowing how to use them. It's like if you send me the directions to a technical machine, I maybe have the directions, but I don't know how to use it.
I totally get that. That's how it is with our compliance. You know, we have forms that we use to make a note compliance and disclosures to the buyer and the borrower and the seller, and yet you still need an MLO to sign off on it, and you need a lot more besides those disclosures.
Right. So. Well, no, I'd be happy to share this with you and your people because these 19 things are not secrets, but most people, unless they're experienced in the business, they can't implement them. But yeah, I'll send them.
Okay.
Larry, let's talk about some interesting appraisal jobs that you've done in the past. Can you think of one that comes to mind?
I can think of one that comes to mind. It's kind of a boast on my part because it was a $9.5 million note. Can I boast?
Of course.
Okay. Well, here's the case in a nutshell. A couple got divorced, and they had a property settlement. And part of the property settlement was the divorcing husband had to set up a trust for their son, who was a minor, and fund it with $9.5 million cash, which he did. So he put $9.5 million cash into this trust for his son, and one of the terms of the trust was that at a later date, the husband could substitute assets in the trust. In other words, he whatever was in the trust, he could put something in of equal value and take that asset out of the trust. So 4 years went by, and the husband, the divorced husband, came to the trustee and said, you know, you've got $9.5 million of assets in that trust. They're invested in fidelity accounts, money market accounts, government bonds, and so forth. I want to substitute my $9.5 million promissory note for those assets. So the trustee said, no, I won't accept it. Your $9.5 million promissory note is not worth what these assets are. And the husband, the former husband, who was a wealthy man, showed him that he had big net worth and so forth, and that would be a like-for-like type exchange or an equal value exchange. So I was called into the court case to be an expert witness to value the promissory note. And so basically I applied some of these 19 factors to the note and wrote an appraisal report and documented it and came to the conclusion that that $9.5 million note had a fair market value of about $5.5 million. And we went to court, and I was devored, I think that's the French pronunciation, devored, to find out if I was qualified, and we ended up winning the case. But the point I'm making here is even the most sophisticated, rich people create promissory notes without guidance that have flaws in them, and it comes back to haunt them. So that's just one example of a sophisticated person who didn't get the proper advice at the inception and ended up losing a very big case.
Very interesting.
Yeah, that's great.
Yeah.
So Larry,
go ahead.
I was just, is there another thing that's similarly maybe an estate settlement or something you can think of that was more normal?
Well, let me say this. No matter how many zeros are on the note, whether it's 9 million or 900,000 or 95,000, I use the exact same principles and guidelines to value the note. And so when you say a more normal, I think what you mean is a smaller size note that most of us can get our arms around, but the principles are the same. And if a person doesn't get competent advice when they're structuring a promissory note that has a value that's meaningful for them, let's say they're structuring a $9,500 note, and that's all the money they've got in the world or all the equity they've got in the world, and they don't get advice on that, they're going to end up probably getting hurt. So all of my valuations really become kind of cookie cutter in the sense that they may have 2 zeros or 3 zeros or 4 zeros after the number, but all these conditions have to be met to make the note enforceable in law, collectible, and marketable. And so it's kind of a unglamorous type thing to do, but it can cost somebody their life savings if they don't do it right.
And you know what? That is exactly the business. You know, this is a good, not conclusion, but a good conclusion for lack of a better word. Is what we're doing is we're creating a collateral file that is compliant and seeks maximum value. And it appears to me after our conversation, Larry, and something that we already know, and this is really, really important to getting out to the rest of the world, is that laws have been created by bureaucrats now that have not been tested in court, and we're actually like guinea pigs in a way. We're trying to create something that is the best that we think it can be, but the real test is court cases that are coming down the line.
Right. Just as I said, I consider your firm to be a pioneering firm.
Well, I mean, it's like anything else. If you're going into battle, you don't know your armor's going to for sure protect you, but it's certainly better than, it's certainly
Right.
better than going into battle naked.
Well, let me give you another kind of pat on the back. Let's say that you have to operate without the benefit of any case law, which is the case,
Yep.
And let's say a client comes to you and you do everything you can and you create the file, and somebody sues him and wants to nullify the transaction, and he goes into court and he shows the court, look, I hired experts to help me.
Yep.
These people did everything they could to help me, and they acted in good faith, and I acted in good faith, and I have a feeling, in a general sense, the court will say, look, why punish this guy who did everything he could at the time to do it right? So I think your service, putting a file together, shows a evidence of good faith on the part of the note holder and on your part, and I think that goes a long way in court.
Yeah,
Very
for
good.
sure.
That's interesting to hear, because also the law says that I've read that even if you did something wrong as an owner and you unilaterally correct it after the fact, that's sufficient to keeping its value intact, as long as you haven't done it maliciously and then and you're trying to get away with something. So they do allow you to go ahead.
Yeah, let me add something to that. I've been a witness in court, and I personally, over the years, but not recently, have done a lot of foreclosures myself on notes I held. And I found that at the trial level, most of the judges, in fact, all the judges, really look for good faith and a positive attitude. If they think you did if they think somebody did a transaction to screw somebody, or they did a transaction to circumvent somebody, they'll really hammer them. And if the judge, the trial judge, feels that you acted in good faith and you did the best you could, they'll go easy on you. And so let's say if they were to go hard, they could nullify the loan, they could make you pay back all the interest, et cetera, et cetera. And if the judge felt you were acting in good faith, he probably could say, well, look, we're not going to nullify the loan, we're going to modify the interest rate, and we're going to stretch the terms out because nobody intended any harm. So I really think that if you guys create a good file for people, it's like a little insurance policy.
Very good.
Sure, for sure. So in wrapping up, Larry, and this has been an awesome call. We really want to thank you for your time and effort and guidance and expertise. And obviously, we naturally look forward to a great working relationship with you. And we've been talking with Donna Bauer about putting together a platform along with our attorney who specializes in this space, Jim Eckley, who we've interviewed. We've actually interviewed both of them. And how can people get a hold of you?
Well, basically, I work nationally, and I've got a website that's www.promissorynoteappraisers, plural, promissorynoteappraisers.com. They can go on that website and find me. And my email address is actually my name, Lawrence, Lawrence, .Tepper, Tepper, @Comcast.net. They can reach me that way, and my phone number is 303-779-6996. And what I do mostly when people call me, they call up and they say, how much are you going to charge me for an appraisal? And I say, well, I can't give you a price sight unseen, because it'd be like you calling me and saying, how much will you pay me for my car? And I say, well, I've never seen your car. So basically, I look at people's documents free. I don't charge them. And then I quote them a price for what I think is the service they need. They may only need a couple hours of consulting, or they may need a full appraisal. So basically, a phone call or an email to me isn't going to cost anybody anything, and they might get some real benefit out of it.
That's an awesome approach, Larry, to that. So, yeah, that's a good way to work.
Yeah. Well, again,
Well, if I can help any of your people, I'd be very happy to.
great. All right, guys. Hope you enjoyed this call and
All
got as
right.
much out of it as we did, and we'll see you next time. Thanks, Larry.
Thank you. Bye-bye.
Bye-bye.
Take care.